Hello, investors. Thank you so much for joining us. This is Michael from Deep Value Returns on Seeking Alpha. I run a premium newsletter with a hybrid stock portfolio. So kind of look at some kind of high growth names and some value names. And yeah, this is kind of would fall into more into the value bracket. So we're going to go through that. Manuel, what about you?
Hi, I'm Manuel. You can find all about my work over at allingstocks.com. And today I'm bringing you Semler Scientific, which is a software, I would say it's a SaaS business disguised of a medical device company. And I just found it out last week. Well, I've read about it before, but I'm really into it from since last week. I sent it to Michael. He read it. He read something about it. I've been all weekend learning about researching it, so I thought it would be a good idea to bring it here to the podcast.
Okay, so just before we kind of jump in further, like how has the stock performed in the last, let's say, year or so? How has it kind of done in the past year, would you say?
Well, the stock has been a great stock to own for the past, I don't know, 5-10 years. In the last Q3, the third quarter results were growth was a bit lower than expected by the street, of course, by analysts, and the stock came down, I think, like halved, like from 150 to $80 per share, because expectations were too high. The thing is, I would say, and we can get to that, it's just it could be, or it's probably very transitory, and the growth prospects for this business are just amazing. And you were saying offline, and then can go there at the end of it, but you were saying offline that it's a bit expensive for you. I think it's one of those stocks that you got here 5, 10 or more years of amazing growth. It's really wide open, the market for Semler. So 35x multiple is for me, and I'm not a growth investor. Usually I don't pay too much for stocks. I think it's an amazing opportunity. So
before we just go a little bit further ahead. So from my understanding, the company doesn't offer any guidance as of right now. But from my understanding, just kind of digging into the revenue prospects, how the company did in Q3, that kind of worried investors. So can you remember? I think it was 30% top line growth. Is that what you remember?
Yeah, exactly.
So that's quite a strong growth,
year on year was 30%. Can you hear me correctly?
Yeah, I can hear. Yeah, okay. So 30% is not bad, is it? It's quite a strong growth rate.
No, but it had in Q2 it had grown for 125%. So 30%. The thing is, it was sequentially on a quarter-on-quarter basis, it was down. So, and this is because they have two types of revenue. One is fixed subscription revenue. The other one is per test revenue. And this one just shrunk. The company management didn't properly explain why they saw that shrinking, and investors were waiting for a higher growth. So they were not happy with 30% growth, and mostly the price was really stretched. The multiple was really stretched because everyone was expecting the growth to go on and go on and go on at crazy levels. So 30% growth, investors were a bit sad about it.
Yeah, I think this is something that I've seen recurring so much in the last, let's say, 3 and 6 months. There's been a bit of like coming out of going into the COVID crisis, everything kind of got switched off. And then coming out, a lot of companies like Semler Scientific and others, as they lap that start of the COVID period, they're putting out very strong results right now. And then everyone gets really excited, right? The company's doing well, everyone's like jumping and very satisfied. But then as we get later into the COVID cycle and the lapping of the tough comparables with the previous year, particularly Q3 in this example, and you can probably extrapolate this to mean Q4 as well, it's kind of like, okay, the company I thought was growing at, let's say, 100%, and it's no longer growing at 100%, it's growing at 30 or even, let's say, 27 or something, and it's like a different ballgame. And people kind of, I've just noticed a little bit. I've seen this in many stocks. Like I've seen this in Peloton. I've seen this in Roku. I've seen this in like countless stocks that I've seen this happening, where people, instead of taking like a 2-year look at like this, is how they were doing in 2019. There was some bumpiness, and this is how they've come out in 2021. Everyone is just like, oh my God, it's the comparables are all over the place. Is that how you feel about it?
I think it was not as much as the comparables to last year. It was a comparables to last quarter, because apart from Q2 2020, since 2017, there was in every single quarter the company grew its revenue. So it was more quarter-on-quarter view than that. But I also think it's just depending on why that happened, which the management still doesn't have a plausible explanation. I think it's just short-sightedness, and this is amazing because the company, and I think we should go on to explain what the business does, so our viewers can understand this. So
yes, so go ahead,
this is the Semler is a disrupting software company. It's, as I mentioned, it's disguised as a medical device company, which its growth margins are 93%, operating margin 40%, growing at 30%, and a return on invested capital of over 200%. So the great thing about this is the margins are super high, not just the gross margin as in many SaaS businesses, but because of the distribution model of this company, it has super high operating margins and net profit margins. It's profitable already, and it's on this level, it's amazing. So what does it do? So it comes to solve the diagnosis of PAD, which is peripheral arterial disease, which is a narrowing of the peripheral arteries, also called atherosclerosis. So the blood flow reduces while your arteries get thinner.
compressed.
So compressed, exactly, not thinner, compressed. So people with PAD are 4 times more likely to die from heart attack and 3 times more likely to die of stroke. But there is a problem, because most of them they're not diagnosed because they're asymptomatic. That's the problem with this disease. So the current state-of-the-art technology is called ABI, which is the doctor puts some inflatable
cuff,
blood pressure
yeah,
cuffs. Yeah, exactly.
An arm cuff, yeah.
Exactly. And then with an ultrasound device, it measures your, it's not the blood pressure, but something similar to that. The issue with this is that because it's asymptomatic, most people, it goes unnoticed, and it's got to be performed by specialized vascular technicians. Not everyone can do it. Your family doctor or general practitioner can't do it. A nurse can do it unless they're specialized in this. So there's an issue here, which Semler comes to solve. Semler owns one product that's a risk. We can go there afterwards, which is called QuantaFlow or QuantaFlow. I don't know how to pronounce
Yeah,
it exactly.
Quanta, yeah.
QuantaFlow, which is just a clip that you attach to your finger or toe, and then after 4 or 5 minutes, it goes to the software, cloud software, and the software spits out the result and tells you if you have that disease or you don't have that disease in a few minutes. The thing about this is that everyone can do it. Testing can be performed without a referral, and it can be done by any general practitioner or any primary care provider. Currently, the company estimates to have a 4% market share, and so the future growth is really big, and it's a much better product than what exists right now in the market, as I've mentioned, the ABI testing. So the good thing, this is all nice and good. So they sell, what they sell is more of the software than this little clip. They sell it, I would say, for cost. I haven't been able to confirm that, but that's what I've been reading. And then they sell the software as a service with a subscription, and sometimes they sell it per test. Okay, so 2/3 of revenue is a subscription model, 1/3 of revenue roughly is per test. So by doing this, they don't sell it. There's no upfront cost for the customers, and their customers, they don't go to the doctors or to the hospitals. They're taking a different route, which is they go to the insurance companies and the at-risk detection companies. And those companies will do, mostly the insurance companies will do the marketing, the sales and marketing efforts for Semler. That's why, unlike many other SaaS businesses, Semler already has super high margins because they're not doing all the legwork of selling this to the doctors. I've read, and I'm not sure how accurate this information is, that insurance companies actually pay the doctors to use the QuantaFlow because they're saving so much money knowing which patients or which clients have this disease and which don't have, that they're able to pay both ways, pay Semler and pay the doctors to use the QuantaFlow. So
just, yes, sir.
No.
There's one thing that like is popping in my mind right away is this is obviously very, very exciting because you are doing early detection work. And as you're already talking about, for insurers, this is really something that's very important. If you have someone on your insurance and there's going to be downstream complications, it's much more costly. It's much better for them to go with someone like Semler or whatever and have that early detection to be able to detect any kind of risk in peripheral arthritis disease, because they talk about Semler, and it's easy to believe that there's a very high return on investment for the insurance company because you hired and you solved the problem right today, rather than 12 months down the road, you having hospitalizations and all those kind of insurance costs kind of ramping up. That's all I was going to say. But yeah, sorry, continue.
Exactly. I love how you can get the picture of a business, Michael, with just 1 or 2 days notice. I'm still baffled of your ability
you're very kind. You're very kind. Thank you.
to understand all of it. I take a lot of time understanding everything. So these guys, to sum it all up, these guys are disrupting this testing diagnosis market. They're much better than what's out there, and best of all is that everyone can do this. More or less everyone can do this, can perform the testing. So the next question is, what about competition?
Well, just before we go to the competition, so just one moment here. So the competition is something that we'll kind of talk about in investment risks, but just before that, so I kind of looked at this and I'm like, okay, very, very good news is that there is no capex requirement. You know, what they make in terms of, let's call it operating profits, drops to cash flows from operations, which there's no capex, so it's basically free cash flow. Okay, that's really, really good. I like that. You know, then nobody complains there. What I would say, and these things are always difficult, but what I would say is that there has been on Q3 particularly some compression on the operating margins. Now, this is not a big deal, you know, but when you're only working with small single-digit $1 million figures, small changes can have dramatic impact on the operating margin profile of the business. Looking back, the margins have been, as you described, close to 40, sometimes 45%. You know, it's insane. But right now in Q3, it's compressed. So you have that kind of
38%, and there's an explanation for that, which is there was this revenue decline not in the subscription based business, but on the per test, which is done at home by companies that do this, that go to people's homes. So this one is paid per test. The management doesn't exactly know why this happened. It's talking about COVID, the new variants of COVID, blah, 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 blah. That coupled with an increase in costs to ramp up sales, so they're hiring more people. They seem more interested in their products, and they've been doing this for ages now. They're seeing high amounts of engagement from their clients asking more product. They're going to new clients, so they're seeing all of these demands, so they're spending more to fulfill the demand, not to fulfill the demand, but to go after new demand, to new clients. So that operating margin decline, I would say, again, it's temporary, and the opportunity, and I know that it depends on your time frame, but the opportunity is just huge, right? So it's just a quarter, and thankfully there was this quarter, and it might happen again in Q4, and it might happen again in Q1. I don't know, but the opportunity is so big that I just don't really care about short-time blips. But as you said, and as we've mentioned here before, it depends on your time frame, right? Your time horizon. If you're looking
So
for the
I'll
next couple of quarters,
I'll just add three little minor points. So actually looking at the share price, you kind of get the ability to get involved as a business owner of Semler as if you had bought it, let's say, back in 2020. So it's kind of like reversing the clock. You'll be able to take the company back and get it at that price, although you know right now that how much intrinsic value they've grown. It's like you're getting the visibility of buying the company at 2020 prices, knowing that they've kind of climbed and grown so much, and you're getting it at a discount. So that's just kind of like a little comment that I want to say. The second thing that it's quite exciting when I look at this, that has no debt. The company has no debt. It's basically like you saw a cash. The balance sheet has approximately 7% of the market cap is just made up of cash. I think it's approximately 40 million that they've got of cash and cash equivalents. I mean, so if they can keep playing this game all day, every day, because as you're talking about, it may be just a temporary blip in terms of the margin compression, but there's no worries there because they can continue playing because they've got no debt on their balance sheet. I think that's something that's absolutely worth noting as well here.
Yeah, that cash can be looked at as a problem as well. And I'm going to try to explain, which is the reinvestment rate, the ability to reinvest profits, right? Because it's so capital light, it doesn't even have where to invest those profits. So what it's doing right now is buying or investing in other companies in order to diversify away from just their core product. They understand that they need to have more products, especially so when they have a high customer concentration, which is one risk. They have two big customers, which account for 70 or 80% of revenues, because it's like a funnel. It goes through the insurance companies, and then the insurance companies distribute it to all the doctors. So there's a risk. And the cash, they're now going after new products internally and through acquisitions, but still they still can't reinvest all the cash. And that's a good thing and a bad thing, because the return on investment, it's just bonkers, amazing, 200% if you back out the cash. But it would be amazing if they could reinvest it back into the business. So it's
having a lot of cash is never going to be a problem. There are a lot of problems. For a business, having too much cash is not the problem. You can do a special dividend. You can do lots of different things.
You can buy
you
shares,
kind of talked about this, and I kind of wanted to kind of unpick here slightly. So you talk about them doing like 2 or so investments in other companies, into new companies. Can you tell me a little bit about that, please?
No, I can tell you a lot about that because it's in the space, but the management is really, really tight-lipped about everything, right?
Yeah.
They do conference calls, but they don't, as you said previously, they don't issue guidance. They don't talk much about the business, who their clients are. Of course, that's usual procedure, but they don't talk much about what companies, the 3 companies that they're investing in. They just say broadly where they're working, which area they're working on. So I can't tell you much about it. So we just got to be hopeful that the management knows what they're doing.
Yeah, it reminds me a little bit of when you talked to me before about Dillard's. Dillard's is another one. Notorious doesn't like do proper investor calls and stuff like that. And the stock was up like 800 to 900% in like since 2020. So, I mean, and you obviously got the example of Berkshire as well. So having, no investor calls or no guidance doesn't really tell you anything at all of any sort of anything. So that's not a big problem. It's kind of, you just have to, understand that is management holds a large proportion of the stock here, and they're very much motivated to kind of keep going after the opportunity, because if the share price doesn't go up, most of their net worth is tied to the share price ultimately, so they're not going to be benefiting either. So just to talk about now, can you tell me about the valuation? How do you think about this?
The valuation, depending on the way you look at it, I like to look at price to earnings or price to free cash flow. It's roughly 34 times this year, 2021. So last year's Q4 is yet to be released, the numbers. So around 24 times earnings, which usually I would say, well, that's a lot. But if you look at the runway here, they've got the whole wide market open to them. They have 4% market share according to the management. I'm not sure yet if they're talking about market share of the patients that are already or currently being diagnosed, or from all the patients, all the people suffering from this disease that are being diagnosed, which are 70%, estimated to be 75% of the people with this disease. So I'm not sure about that, but even so, 4% with a much better mousetrap than the current state of the art is just, for me, it's amazing. The runway is really big. So 34 times earnings, growing at 30% in a bad quarter. I think it can be really cheap. You can look at it in 5 years' time and say, and triple or quadrupled or whatever your money, your cash, and look back and say, this was a great opportunity, and I'm happy I didn't miss it.
So just one more thing that I want to highlight: potential investment risk. So let's say you're a physician and you have the chance to pay Semler kind of a recurring revenue stream, or you can go for alternative product B, where you pay capital upfront once and then you can use it for 5, 10, 15 years. So why would a physician want to go for this potentially more expensive revenue stream rather than just pay for something off the shelf one-off?
First of all, because they don't sell directly to physicians, they sell to the insurance companies. And because they're the only player in the market who can diagnose all of these patients without going to a specialized doctor, right? By referral. They can be diagnosed by their general practitioner or a nurse. So this is highly valuable for the insurance companies. It saves them a lot more money than what they would pay for if it kept being undiagnosed. And the competition, well, there's the ABI testing, which we've talked about previously. There's one company, which is Medtronic, giant medical device companies, very well known. They bought this little company, which has a competing device called Flowmeter, but it's slightly different because it's real time. They give you the real time blood flow. So they're going after surgery, and it's not to diagnose it outside of surgery. It's for surgeons to check if they're doing something wrong, and if the meter will tell them if they're doing something wrong or not. If this device can be, or technology, because the device is just an iPad, the thing is the software, if it can be changed in some way to go after the diagnosis as Semler is doing, I believe it shouldn't be that hard, because they're doing something which is slightly better than what I believe, and I'm not a specialist on the technology, but slightly better than what Semler is doing. But once Semler reaches or lands a client, one of these companies, I'm not sure if a general practitioner would need to see the blood flow live or real time instead of waiting 3 minutes. I'm not sure, and I'm not sure of the price of it. So I'm not sure how much better it is for a doctor to have it real time instead of waiting 2 or 3 or 4 or 5 minutes. So I'm still not sure if it's a serious competitor or not. For the meantime, they're not going after the same market.
Okay, I think that pretty much wraps it up. So I think that, I actually looked at it and I was kind of like looking at it and I felt probably closer to 20 times, 22 times forward operating profits. It is quite cheap. There's the question, which we discussed a few times throughout already today, that, there was some small amount of volatility, but it's really, there's a lot of compounding to still, and the runway is still quite long. And yeah, I think that's really exciting. I would like to say thank you to everyone that kind of joined us. Manuel, do you want to wrap it up? Do you want to say anything from your side?
No, just thank you and see you next week, Michael.
Yeah, thank you so much. Bye-bye.